Dear students, knowledge seekers, and learners, welcome to Lecture 3 of Week 2, wherein we are going to talk about role of financial institutions. In today's lecture, we will be starting by understanding and deliberating upon the meaning of financial institutions, followed by the need for financial institutions in the financial system. Subsequently, we will try to deal with the core functions, followed by role in savings and investments. We will also talk about credit creation and allocation with respect to financial institutions. Risk is one of the important components that financial institutions has to deal with. That is why we will also try to decipher the different issues related to risk management, followed by role of financial institutions in economic development. In the end, we will try to discuss the institutional efficiency and different challenges that are there for the financial institutions. Let us begin the journey. Let us try to find out the meaning of financial institutions. The standard definition suggests that financial institutions are organizations that facilitate financial transactions and manage funds. The primary objective is facilitation. Facilitation refers to providing a smooth pathway for financial transactions to go uninterrupted. It also means that the bottlenecks that are present in financial transactions should be minimized. It may also refer to the minimizing of the time taken in completing a financial transactions. All this together constitutes financial institutions. Financial institutions operate between two entities, that is savers and borrowers. Thus, we can say that they act as a bridge between savers and borrowers. While savers have surplus units or surplus finances, the borrowers are the entities and units that have deficit financing. Thus, financial institution tries to bridge the gap from transferring money from those who have more to those who have less. Thus, it is clearly said that financial institutions are a bridge between savers and borrowers. Financial institutions form the operational core of the financial system. And this operation core is very important for any successful financial system. Let us now try to delve into the need for financial institutions. Financial institutions presents a direct interaction between savers and borrowers. This direct interaction between savers and borrowers should be taken into consideration as per the needs and demands of the financial institutions. Generally, it has been found that if there is no involvement of financial institutions, a direct interaction between savers and borrowers is inefficient because there is no specialized unit that can deal with both the borrowers and savers. Similarly, a direct interaction may also lead to more risk, thus making the whole financial transaction riskier. In addition to this, a direct interaction between saver and borrowers appears to be expensive, costly in times when financial institutions are not involved. Financial institutions can involve and thus can substantially reduce the cost through different financial management techniques. Thus, financial institutions are very important because they simplify the financial transactions, making it easier for money to flow for funds to be transferred. Similarly, financial institutions also reduce the information gap that prevails between borrowers and savers. Due to lack of information between borrowers and savers, at times the parties are not able to get a minimum rate of interest or minimum rate of return. Thus, when there is information and the information gaps are reduced, the market becomes more competitive and more information leads to better prices for both the savers and borrowers. The financial institutions are also required because they provide structured financial services such as underwriting, promissory notes, bills of exchange, etc. All these financial services, they act as a platform for businesses to accelerate their business transactions. Thus, it would be justified to say that financial institutions make financial activity organized as well as reliable. Let us now try to find out the core functions of financial institutions. The first core function of financial institutions is mobilization of savings. We all are aware that the domestic household sector, the people, they earn their livelihood, they spend money out of their incomes, and they save a part of money for contingency or for any future requirement. This is known as savings. The savings of the domestic sector have two options to be applied to. One, the savings can be kept with the household. So savings can be kept idle with the households, that is, it is idle, or it can be put to any investment option where we can expect some kind of a return. So what is important is that there are two ways. Now if we compare these two, A1 and A2, we know that A2 is always better than A1 because if we are keeping saved money idle, then also its value is decreasing because of natural rate of inflation. Thus, the logical and the more appropriate way is to put money into some kind of units and entities where some kind of return is able to control the value. Thus, for this purpose, it is important to mobilize savings so that they can be converted into investments. The second core function of financial institutions is allocation of credit. Credit availability is subject to in which sector it is going. Credit always needs to be allocated according to priority sector, according to rate of return, according to immediate need, etc. The third core function of financial institutions is financial intermediation. Financial intermediation refers to bridging a gap between savers and borrowers. This financial intermediation is important because this intermediation provides a expertise knowledge that can help both the borrowers and savers. The next important core function of financial institution is risk management. Risk is something which is associated with each and every financial transaction. It is also said that the more the risk, the more is the return. Whether risk is high or low, risk management techniques are always to be used by financial institutions. And the objective is to safeguard the interest of investors, particularly the small investors. The next core function of financial institution is liquidity provision. Liquidity refers to the cash flow requirement of the business for day-to-day operations. Financial institutions can provide liquidity to the entities, businesses, firms, etc. And that particular provision is one of the most integral function of financial institution. Thus, in a nutshell, these functions, which are core functions of the financial institutions, they support the entire financial system in the Indian economy. Let us now talk about a role of mobilization of savings. In the financial system, savings are collected from individuals and businesses. These savings are collected through different modes such as deposits, investment schemes, etc. Mobilization of savings convert the idle funds into productive resources, thus providing better opportunities and thus expecting more return from the idle money. Mobilization of saving also enhances capital availability in the economy, thus putting less reliance on foreign investment. Dear students, knowledge seekers, and learners, let us try to appreciate the role of financial institutions in credit allocation. Financial institutions provide loans to businesses, individuals, and governments. The nature of these loans may vary. For examples, loans generally given to businesses are long-term loans or they are collateral or mortgage loans where the rate of interest is flexible and it depends on the reputation of the business. In terms of individual, generally the rate of interest which is extended depends on salary structure of the individual or income of the individual and also on the number of EMIs, that is period of return, that is being decided. Similarly, for government, the whole setup and mechanism of credit allocation is altogether different. Financial institutions play a vital role in credit allocation. The credit allocation is always based on the first factor is credit worthiness, that is the ability to return credit. The ability and historical capability to return the principal money. This is credit worthiness. So, if people are taking and firms are taking credit and they are returning in time, they are not defaulting, it means that credit worthiness will improve. An improvement in credit worthiness indicates that there is more credit availability, there is more possibility of credit allotment to those businesses. The second, credit allocation is based on risk assessment. That is, what is the level of risk? What is the default risk? What if a person is not able to repay the loan or in between becomes defaulter? So these things needs to be calculated because financial institutions always want that the non-performing asset should be minimized. Once a loan becomes a default loan, the loan borrower defaults, the loan is then transferred to non-performing assets. Thus, the objective of the central bank and other financial institutions is to minimize the non-performing assets. Credit allocation by the financial institutions ensures that funds are used for productive purposes rather than for consumption purposes. Financial intermediation function. Financial intermediation is another important function that prevails good faith in the financial system. Financial intermediation act as intermediaries between lenders and borrowers. Financial intermediaries reduces the transaction cost by providing expertise and also reduce the information asymmetry by providing correct and precise information and making the market more competitive. Thus, overall, financial intermediation improves efficiency in fund transfer. Another function related to financial institutions is credit creation function. Credit creation is a very interesting concept and function. For example, if a bank has received a deposit of 1000 rupees, then how much money can be created through this 1000 rupees? Now, at least this 1000 can create a credit of around 8 to 9000. So, what actually happens? Suppose there is Mr. X who wants a loan of 1000 rupees. So, the bank which holds this 1000 rupees will give loan to Mr. X, he will get 1000 with condition of utilizing money in installments. That is, altogether you cannot use 1 lakh, you can take first 51,000, means altogether you cannot take 1000, first you will take 500, then 300, then 200. Some kind of permutation is always there. So what happens is, once X takes a loan, the loan is transferred to an account, and whatever bank account is there, that bank account can use this 1000 again to give to somebody else. Say for example, if it is expected that X will use in next few days 500 rupees, so remaining 500 can be given to somebody else, say for example Y. So this whole cycle continues. So it multiplies the credit, and this credit creation function is one of the very important and majestic functions of the banking sector. Under credit creation function, the process starts from accepting the deposits, then extending those deposits as loans to the other people, the consumers, and finally expanding the money supply. Credit creation function plays a key role in economic activity in Indian financial sector. Let us now try to talk about the risk management role. Institutions help manage financial risk. There are different techniques through which they are able to help risk management. The first is diversification. The risk can be diversified, which means it can be transferred to different other entities. Insurance also provides safety net for accidents, etc. And credit evaluation. The credit evaluation helps to understand that if we invest X amount of money into a particular bank, institution, or scheme, how much we'll get and what is the credit evaluation of the company. Thus, overall, we should appreciate that risk management rules encourages investment and economic confidence in the Indian financial system. Let us now talk about the liquidation provision. All the financial institutions provide easy access to funds. Liquidity is very important for businesses, firms, and other institutions because all the day-to-day operations are performed through liquidation process, that is through the liquidity, that is cash in hand. The liquidation provision enables fast and easy withdrawals. In addition to it, it also includes short-term financing which is required to uphold the day-to-day operations. Thus, liquidity provision maintains smooth financial operations. Payment and settlement role. Let us now try to discuss this particular aspect of financial institutions as well. Payment and settlement role of financial institutions is about facilitating payments in the economy. We all know that payments are important because they run the economy, in the sense that the whole cycle of payment, consumption, expenditure, income keeps on rotating. Payment and settlement role of financial institutions include the banking transactions that they are performing as well as the digital payments in which they are up to. Thus, payment and settlement role is essential for daily economic activity. Let us now try to understand the role of financial institutions in economic development. Number one, the financial institution supports industrial growth. In India, there is an index known as Index of Industrial Production. Okay. Now, this index is measured from time to time, and this index tells that how much growth is happening in the industrial sector. Without substantial and sustainable growth in the industrial sector, we cannot further use this element as contribution towards the economic development. The second important role is related to finance infrastructure in economic development. Financial institutions provide proper funding so that the infrastructure of any economy can be improved. The third role of financial institutions in economic development is promoting entrepreneurship. Entrepreneurship is again very important because it brings new products, new ideas, and captures new markets. Thus, in a nutshell, it will be justified to say that financial institutions play a vital role in economic development and acts as catalyst for economic progress. Dear students, knowledge seekers, and learners, let us now try to appreciate the role of financial institutions in financial inclusion. Financial inclusion refers to extending the financial services to underserved areas. Financial inclusion includes rural banking, microfinance, etc. Financial inclusion is important because the more people comes into the fora of developed sector, into the fora of organized financial system, it can reduce economic inequality substantially. Imagine a situation in a country where financial inclusion is low, people are not participating in the financial system, then how can expect the growth to come out of that particular economy? Thus, financial inclusion is also very important for accelerated economic growth of any country. Let us now try to understand the role of financial institutions in capital formation. In financial institutions, capital formations happens by converting savings into investment. For this particular conversion, obviously mobilization of savings is required. Also, capital formation supports long-term projects with the help of financial institutions. Long-term projects may not give immediate returns, but their viability and sustainability is more in comparison to those institutions that are given immediate returns. Thus, in the end, financial institutions play an integral role in capital formation and strengthens economic growth with capacity. Let us now try to understand and appreciate the institutional efficiency that is being promoted by financial institutions. The institutional efficiency of the financial institutions depends on transparency, it depends on risk management, as well as technology adoption. Now, all these three parameters are very important and integral. The reason being, if we want to secure and stabilize a financial system, a transparent system is required. The transparency in financial system refers to full disclosure of information which is required by different stakeholders of the financial sector. Stakeholders such as government authorities, regulatory bodies, investors, business firms, brokers, etc. Similarly, institutional efficiency also depends on risk management, which tries to answer the question what kind of strategies have been adopted, why they have been adopted, how the risk has been calculated, what have been done with respect to sharing of the risk, etc. Similarly, another important issue with institutional efficiency is technology adoption. As every day technology is transforming, there is an immediate need to improve the technology and adopt technology. At times, it has been seen that old institutions do not try to imbibe the new technology, which further hampers the institutional efficiency. Thus, institutional efficiency is one of the pillars of financial institutions. In the end, we can say that efficient institutions improve overall system performance and the financial system becomes more robust, stable, reliable, as well as the investors' confidence is gained in that particular system. Let us now try to highlight the different challenges faced by financial institutions. The first challenge is related to non performing assets. Whatever loans are being extended to the customers, and the customers, when they default, those loans are known as NPAs, non performing assets. Non performing assets over the last years have gone down, but still the huge amount of money which becomes NPAs is a concern for the regulatory bodies. The second challenge faced by financial institutions is regulatory constraints. There are different regulations that sometimes appear to be overlapping, but these regulatory issues are also to be dealt with so that they may be simple, they may be of limited number, and they may be easily understood by everybody. The third type of challenge is technological risk. With the rapid change in technology and technological innovations coming every day, there is always a risk associated with technology. These risks may be the technology obsolescence, it may also be problem in adoption of technology, it may be cost of technology adoption, etc. And finally, the challenge is the competition from fintech companies, that is, financial technology companies. Several companies are coming with their mobile applications with ease of taking money and ease of doing transactions, and this has given a tough competition to the financial institutions in Indian financial system. Thus, this is also a major challenge which is faced by financial institutions. Thus, challenges are many, but these are the core challenges affecting the operational efficiency. Dear students, knowledge seekers, and learners, let us try to discuss some of the emerging trends in financial institutions. The first is digital banking. Digital banking refers to use of computers in banking services. The second is fintech integration, that is financial technology integration. This integration is very important because this brings finance, that is the basics of finance, plus technology. Now, finance plus technology is the new trend. So, you can sit at your home, you can use a laptop, and then you can do all the trading without visiting the actual markets. Similarly, financial innovation is another emerging trend. Now, in this financial innovation, new types of financial products and services are being launched, and they provide better opportunities and options for the customers of the financial system. Thus, the emerging trends reflect that the whole financial system is pushing towards a transformation where traditional institutional roles will be replaced by the modern institutional roles. Dear student, in the end of the lecture, we will try to recapitulate and summarize what all we have discussed in today's lecture. We have discussed and appreciated the point that financial institutions perform key operational functions. Similarly, financial institutions enable saving mobilization as well as credit allocation. Not only this, financial institutions also support economic development and stability, which is the need of the hour. And finally, financial institutions and their efficiency determines the system performance in the economy. Dear students, thank you very much for being with me in this session.